Welcome, everyone, back to EA Forum. I am super thrilled. It's a very, very dear and old friend of mine, Greg Sharenow, who's joined me from PIMCO. Greg and I have known each other for, I think, way more than 10 years. So I cannot thank you enough, Greg, that you've decided to come and talk to me. And this is, it's a brand new thing we've started, like you and I talked. And I'm hoping that you and I can talk more frequently than just once, because I know you have a lot to offer. You come and you have a very privileged seat, given you are at PIMCO. You look at things and asset classes from a very different lens to a lot of, say, our regular client base, which sometimes tend to be very short-term traders and not looking necessarily at all asset classes. So yeah, very warm welcome.
Thank you for having me. And Amrita, I have to say, you guys have done an amazing job building energy aspects up. I remember when you took the first step and leap and really done an amazing job. So I'm thrilled where you are today, and I'm thrilled to be part of this conversation. And I love the fact that you had Jeff Curry, my first boss, on. So I feel like I'm honored to be in the thread.
Oh yeah, absolutely. I think, and I told Jeff, I said I'm going to get Greg on. He's like, oh, Greg's going to come on board. So he's equally excited. So look, let's get started. I think there's a lot to talk about. Obviously, there's U.S. elections, but I think I'll come on to that in a second. For me, I'm struggling with certain things. I want to get your perspective on that. Like, I can't remember the last time that oil or energy as a whole was this hated, if I may use that phrase, right? Like, nobody's excited about it, even oil traders, and for good reason, right? You've had OPEC kind of manage the downside. You've had a lot of intervention from the US government on the upside. But even in the energy equity space, not really a lot of enthusiasm around this sector. And this is even with a lot of the transition talk dying down. Like, do you get the same sense when you're speaking with, you have a much more varied network and kind of different group of clients that you're speaking with? What's the sense you're getting and your take on this?
Well, in many respects, I think from a broader non-commodity trader orbit, I think some stability in oil prices has been welcomed. The strains of prices going meaningfully higher has a lot of ripple effects and a lot of headwinds for the economy and creates uncertainty around potential policy. I think some stability after year 2020, 2022 is truly, honestly welcomed. And I think the opportunity then to have some rational conversations about other risks that come up, we're able to focus on inflation without focusing on what exactly is happening tomorrow in oil. And people are able to focus more on portfolio construction and longer term thoughts while things are almost, I would say, in the oil market, at least calmer. Now, it hasn't been calm across the commodity spectrum. Look at cocoa prices, look at agriculture prices. There's a lot of opportunities and a lot of interesting things. It's just oil is not front and center today. And that's okay. One thing that I also have noted is that the sensitivity is very different in the US from abroad. Like, our client base, who are international, had experienced an inflation shock that they hadn't experienced in the last couple of decades, because it made a big distinction from prior ones in that it didn't have the organic emerging market growth associated with the higher inflation environments, which would have insulated the economies, helped their capital markets. They just got the inflation shock without the growth. They have the weak currencies, and that client base is the one that's probably more engaged on oil today than they may have been 5 years ago at the similar price, because for them, they experienced something where their portfolios weren't really resilient in the ways in which they had maybe prior thought they would be. Now, from a commodity investor standpoint, if we're at $80 and the market remains in the backwardated form that it is, a commodity index investor is actually really happy. It's almost like back to the 90s. You're allowed to be really dull and actually generate a good return for investors if the carry is positive, and for the investors who are thinking about their long-term portfolio constructions, owning something like oil with a positive carry as an insurance to a potential either geopolitical event or an inflationary cycle, becomes a lot more compelling. So in the US, I totally agree. It's been disinterest and, if anything, more relief. But internationally, we're seeing a lot more interest than we've had in the last 30 years.
Yeah, it's a very, very interesting point you make, because I think that's almost the thing. The traders are the ones that are upset because you've killed volatility to an extent, right? Like vol's been the issue. But if you're an investor, yeah, I mean, if as long as you have a positive carry, that's great, and that's kind of what you want. But do you face the same kind of challenges on the vol side in terms of, and how are people looking at it from your when you talk to your clients?
To be honest, I think from an alpha standpoint or from a risk taking standpoint, there's been amazing opportunities in being shortfall. Like if you do
Right.
have a view, you don't have to just be long vol. There's a large number of investors who have for various reasons, whether it be disposition or whether it be from risk limits, are always needing to be a long vol trader to express a directional view. But if you're not constrained that way, actually having a low vol environment is an opportunity set in and of itself. Now, I do think locally, when I look at the put skew being on the lower end of the last 15 years, when I look at the vol levels being at the lower end of 15 years, like I think short vol may have a problem, but it's probably not from a price spike. I think the bigger issue is if there's a big macro risk off event and the
Yeah.
curve structure weakens like that might actually be a mispricing today. But overall, like being in a low vol environment is not necessarily great for a certain group of investors or a certain group of traders, but for others who are looking at systematic risk premium, for example, like, I mean, it's great, and that's why you do many of these different kind of strategies so that you can kind of take advantage of them.
And are you seeing kind of new groups of investors getting interested in the energy space, like across the board? Could be oil, could be gas, could be really any type of exposure, or is it still the more traditional kind of people who've always been interested in this space? Like pension funds have kind of come and gone, and there's been obviously some other asset allocators who've, they shrunk their commodity portfolio. Now there's a little bit more, but have you seen much change in that space?
Internationally, for sure, there's way
Right.
more interest than before. Um, it's episodic for my whole career. I've done this now 25 years, and there are times where there's more interest and there's times when there's less. Usually the greater amount of interest follows price ascent, and then there's a disinterest when it comes down. I do think, though, this inflationary episode has created a certain group of investors that previously were not, as I mentioned before, and now genuinely are. But when I think about a broader set, one of the conversations we're having here is like, how do you think about the energy transition and opportunities, primarily on the private lending side or the private equity side, rather than like necessarily tradable commodity markets? But the conversations do overlap. Like if you're going to have a view
Yeah.
on the energy transition, there's a critical amount of supply that you have to build into your forecasts that will have to then pair with AI growth and other sort of demand center growth in the power side that has then feedback into your natural gas outlook. Like they're very much interrelated, but I think from the standpoint of where our investors, real money asset allocators are focused on is like, is there an opportunity to deploy capital? We've seen a massive amount of capital raises in the last few years. It's starting to slow down. A natural evolution, there's a lot of
Yeah,
excitement,
of
of
course.
and a lot of funds are launched, a lot of capital is raised, and now they have to figure out how to deploy it all and deploy it all successfully. Which the deep irony is, solar equities, see, we're up 300%, while the S&P was up 50%. Under the Biden presidency, solar equities are down 50%, while the S&P is up 50%. It's hard to get these I know we're going to talk about elections later, but I'm just like saying like the cycles here can be counterintuitive, or a lot of things get priced in super early and then lose interest. But I think on the private energy transition side, there is a lot of need for capital. There's a lot of clients who are looking to deploy capital in things that might help them decarbonize their portfolio over time. So
Yeah.
if it can compete for returns with other asset classes and with other investment opportunities, it will still attract a lot. And that's kind of why we're focused on it, because we're seeing more opportunities to invest, but we're also engaged with a lot more clients who are looking for those opportunities.
Yeah, I think well, since you talked about U.S. elections, we might as well talk about that. So look, to be clear, we're recording this on the 19th of July, and as of right now, it is still President Biden on the Democratic ticket. So again, we don't need to go into any of that. But like I was saying, I just got back from New York, and it was quite amazing how conversations with macro funds and hedge funds, just generally financials, very quickly went from, oh, WTI is overpriced, as in the backwardation, given where margins are, to just talking about what would a Trump presidency mean for energy markets as a whole. Could be energy transition. And like you were saying, a lot of the kind of energy equities were kind of brought up. It was about tariffs and how bad that could be for global growth and so on, right? I mean, do you see things mispriced? Like, I was taken aback, I'll tell you honestly, like how bearish the financial community is right now, regardless of seasonality. And look, our view isn't particularly bullish this year either. That's fine. It's a range-bound market, but it's a seasonally strong period. But it was extremely bearish, not just about, oh, no, we're not drawing stocks, but to the point where it's definitely going to be a Trump presidency, and that's also going to be bearish. And I was like, but there is going to be a loss of Iranian oil, and there was no focus on it, and it was all about how tariffs are going to be the key driver. And apparently his team have held like closed door conversations with hedge funds and have said, we're going to drive WTI to $40. And I'm a bit like, well, that's inconsistent with unleashing a lot of US energy. So I don't know. I mean, you are much more at the heart of it, given you are in the US. I mean, where do you see things mispriced?
Well, to be honest, I'd be happy to be in London right now and avoid the next 4 months if I could climb under a rock. I mean, we've had a year worth of election news in like potentially a week, and certainly if there's a change at the top of the Democrat ticket, it will be a historic
Yeah.
of many proportions. I think there's a lot of conversations within that we can have, to be honest, because I think we haven't talked about the implications of some of the Supreme Court rulings as well. That wasn't in the question. And that's almost just as impactful
Yeah, absolutely.
as a potentially a Trump presidency would be. Now, we certainly think that there's inflationary impacts from the tariffs, but also potentially lower migration. Part of the U.S. exceptionalism has been supported by migration, and certainly if we have the deportations that are being talked about, that's a negative for labor force. So we think there actually is genuine risk that one needs to think about in terms of shaping their overall economic outlook. But the underpinnings to this is that there's wider uncertainty bands than we would have in any other investing year, because either political party wins could have a pretty meaningful implication for actual policy. In addition to that, one of the things that makes it hard is that you have to understand the reaction of other international players to any changes in U.S. policy. So the potential series of outcomes are really, really wide. Now, when we look at U.S. production, for example, our view is it's going to be determined by price more than anything else than policy. Production, the fastest growth has been under Biden and Obama. Trump is meaningfully lower. If you look at like who changed the export restrictions, it was Obama. I mean, the narrative, no one built Keystone XL. I mean, there's a lot of fundamentals that will be driving the outlook that may not be simply just at the top of the ticket in policy. Now, I don't know exactly how the policy with regards to Iran will evolve, in part because the relationships between Saudi and Iran have evolved since that period of time. So the desire input that they may get from more of the Middle East might be different than it was prior. And similarly, like how does it negotiated or forced negotiation in Ukraine impact energy supplies when a lot of Russian supplies are still going to market? I don't think it changes Europe's view. So I'm not sure that there's a clear and obvious opportunity in the oil market itself. I do think, going back to what I said before, if you are concerned about a negative economic price shock to oil, I mean, below delta puts or vol is not pricing that at all. So for now, the tight crude market has managed to keep any of those bearish outcomes from being priced. And I think that is an opportunity. Now, we can talk more about energy transition. And we spend a lot of time on understanding what parts of the IRA are on solid ground and what parts might be revised, and particularly because when the tax cut conversations really start accelerating in 2025, or the extension thereof, there's going to be needs to have pay-fors. And those pay-fors are going to, in my mind, come from a lot of things that aren't being spent. Like, for example, the Department of Energy loan program, any capital that's not out the door would be vulnerable. Now, just to be clear, I don't want to make forecasts on exactly what everything's changed, but like things that would be on our mind on the table. The electric vehicle tax credits, another prime example. Trump has clearly shown a dislike for wind, and I'm not sure that alone changes the global wind market, but I would think certainly it is a negative risk to potential higher wind investment, particularly offshore, given his very deep-seated dislike for that. And I think that could spill over while it could impact the solar impacts are meaningfully less given the support. There could be implications for hydrogen. Now, there could be some ironic ones depending on how they treat the usage of RECs and whether or not the decision to have to match green hydrogen to green power hour for hour is actually ironically potentially a hindrance. So a Trump presidency could be good for blue hydrogen or green
Yeah.
hydrogen plus RECs. And then that creates a weird budgeting problem because that would then mean greater budgeting supports from was it 45V, I believe? And that could end up creating some pushback in terms of pay for. So I think there's going to be a lot of potential supports from the IRA that aren't going to negatively impact domestic manufacturing industries today, but could stymie some further growth that you would get in alternative energy, which by itself is positive for thermal energy, and by itself is probably, and this is not overwhelmingly priced in our view, positive for carbon. Because if you're
Yeah.
going to reduce electric vehicles, sustain, and certainly in California where transportation is included in the cap and trade, which is Europe is trying to do in the long run, but the Trump's presidency won't impact that. And you're going to have more thermal and less renewable, certainly offshore wind support. Like that could probably means more emissions over a longer period of time. Now,
Oh yeah,
one last thing,
100%. Yeah. Yeah, go on.
one last thing. In 2025, and we've been asking questions, and it's not really a hot topic today, but we've seen 3 different Republican senators put forth a carbon border adjustment mechanism legislation in the last year or two. And we've asked former Trump administration and some Republican leadership, and the more conservative end on the fiscal balance, and they've actually been surprised that there is some support at all, and if anything, no opposition or no meaningful opposition. And if you think about it, we like tariffs. You could package it with we like green tariffs,
Yeah.
and all of a sudden you have a carbon-ish border tax, and now how it gets implemented will be important because that will carve out things like oil imports. That is something that is a direct inflation. Maybe they would want to do that. But overall, I think that could actually be also supportive for carbon markets in the United States and the evolution of.
Yeah, I mean, you raise a couple of very, very interesting points. So, but like, okay, first things first, right? Given, I completely agree. Like, for me, it's like, how can you be so overwhelmingly sure it's going to be bearish or bullish for that matter, right? To your point, it's just going to be a huge amount of uncertainty. So, given that outlook, would you actually say, and you did say that vol's kind of mispriced, but would you actually think that people might go long vol into the year, right? Into the year end rather?
I don't know what other people are going to do. I mean,
Yeah.
it's hard to forecast many things right now, but other people's behavior is really kind of high on
Yeah.
the list of things that I can't forecast. The news flow alone demonstrates just how interesting humans can be. But I certainly think that when you get closer, if the election is tight, you could end up seeing it being a higher vol environment than we're
Yeah.
currently in. But expressly owning vol for that in my mind is historically been a tough thing to time.
Yeah.
But if you are really bearish, like I do think vol, conditional on one side of the ledger being demonstrable, like I think that is a mispricing, as I mentioned before.
Yeah. No,
The fact that
100%.
the put skew is so low and the vols are so low means puts are pretty surprisingly low narrative that it's so
And
bearish.
And I think the other thing you are clearly hinting at, and our view very much is very similar, is it's almost long-term carbon prices are too cheap.
Certainly, we've gone in part of the arc is constantly evolving of the energy transition and sort of public policy towards it. But when you get to a point where there's less support for carbon reduction, you effectively have to have more emissions, controlling for same amount of GDP and global growth. That inherently makes the challenge for any program that has a fixed amount of carbon allowances supply, whether it be legislated or by other policy, inherently more constrained. I mean, in terms of the supply and demand, it just it starts tilting the ledger one way. And I don't think that's really entered into the dialogue. And when I start even just looking at things like AI, and there's many forecasts out there right now. I think the IEA put out one today as well. But
Yes.
we're looking at it just like in some of the Western region states or the US, like your last 15 years, your power demand growth in order of like 25 to 30 basis points per annum. I mean, that's pretty small relative to GDP, like noting the demand side measures, noting the efficiency gains, but our outlook, and we're triangulating across a number of different consultants and a number of different forecasters, are looking like 1.5 to maybe 2.25 power demand growth over the next 10 years per annum. Like that is a very big change. And long dated power markets had tried to re-rate and reflect some of this, but carbon didn't. And I think that's
Yes.
pretty strange, particularly if you do think you enter into a world where there's less support for energy transition related investment from governments.
Yeah, I mean, it's funny you talked about AI because that was going to be my third thing. Because in terms of kind of mispricing, you've talked about vol, talked about carbon. Personally, for me, I kind of think power is probably one of those places. And I know you said like long-term power is trying to reprice, but we are seeing this more and more. I think it's very well talked about in the US that there's going to be all these data centers, there's going to be a lot of this power demand. But I think we're seeing this globally. Like, look at the Middle East. Obviously, it's going through a very, very unfortunate heat wave right now. It is extremely hot there, and it's been boosting all sorts of energy demand. But I was talking to a few kind of government officials there, and like UAE, for instance, has just brought in this massive data center, right? I think Saudi is pitching for this as well. And I do wonder, as I mean, I always say this about ourselves as forecasters, like we have to be humble enough to be like, look, we barely get some of these big things right. Like what's going to be the next big thing? And power demand for AI has just been one of those things that's kind of come out of almost nowhere. Do you get the sense, like are investors kind of talking about it and getting interested, but do you also get the sense that governments around the world are really not qualified, but they are really underappreciating what this could do for their grids, for what it could do for like global power demand? And I mean, this is not about oil. This is just about overall thermal or any form of energy. I just think overall energy demand forecasting long term is probably getting massively underestimated right now.
So I do think there are many places where they are thinking critically about it, particularly the data companies, the technology companies that are building it are certainly thinking about this. But if you look at Japan, I think it's a major tailwind for why our forecast for nuclear restarts and our expectations for them are going meaningfully higher. And we just had someone talking to some of the regulators there, and their forecasts are for pretty meaningful increase in demand relative to the past and past forecasts, and as a result are much more aggressive, even talking about additional nuclear investments and looking into SMR investments. And there's a lot of those data centers are going to start finding places where there is either methane to compute or some other sort of trapped energy. So I think there will be some efficiencies and some planning, and there are definitely utilities are considering, do we need to have a multi-tiered tariff structure to reflect the fact that the infrastructure build required to meet that is higher? And on the Middle East specifically, if there's any place that I almost would want to bet that they get it right, is a lot of those countries, because they have the resources, they have the geography in terms of for solar, certainly. They're making investments in the UAE for such as nuclear and looking at investments in other nuclear plants out abroad. But I think that's one place where probably the energy transition might actually be done the best, ironically.
Yes, I completely agree.
They have the resources and they have the desire to be more balanced, to also have a forward-looking image, but also the practicality of the industries that they can bring in if they do that right is something that I think is more appreciated than it is elsewhere. And I think the more central planning nature makes it a little bit easier. But if you start looking in a place like China, I mean, how are they going to grow all the energy transition if the data center growth could be meaningful? I mean, I think it's going to be somewhat challenging. So I do think in a place like that, you could expect higher thermal demand, India, higher thermal demand, and other places that are already struggling just to meet baseline growths with existing.
Yeah, no, I mean, the Middle East thing, I really will echo. And I think part of the Middle East's gripe with the West is almost that the West talks about it, the Middle East is almost doing it better than the West. but doesn't get the credit for it, right? That's kind of always been my sense from talking to them about energy transition. But look, you've mentioned China. I mean, this is almost as if we've planned this, but that was very much, we can't not talk about China, right? Like China's demand this year, at least for energy and oil specifically, has been really, really weak. Like some of the data prints are mirroring COVID, or probably even worse than COVID. And there's a lot of head scratching going on. They are doing a lot on energy transition. I think they are also far, far ahead than the West in many ways. But there's something going on there. And I know you obviously deal with a lot of, whether it be investors and just generally China overall. I mean, what is your take on China? Like, should we be worried? Should we be worried that there's a structural problem finally that people have been talking about for years? Finally here, like, how do you see China as a whole, Chinese oil demand, and just overall the energy sector there?
So one of the challenges we have when we talk about oil is that there's many different types of oil. And when you start looking at oil demand, there's many components. There's LPGs and naphtha that goes into the petchem market. Then there's the on-road transport, the diesel and gasoline, of which some of that is being meaningfully displaced by fuels that are sourced outside of the petroleum spectrum. So we have to think about that side now as being separated to ex-refined products versus refined products. And I think you could say that in places like China, while their transportation demand is actually still good, a lot of it is now happening outside of refined crude oil, and that a large share of their demand growth is coming from the light ends and the petchem feeds. Now, when you think about oil itself, that gets me concerned. If you think about the value of the barrels, the gross product worth, all of a sudden displacing the high value products and with some lower demand, it's like, with lower value products, and that's driving growth, is like a structural problem. And in China, with the displacement of diesel for LNG, the electrification, the migration to greater efficient modes of transportation that are more energy efficient, you can argue that this is not a recent trend, but a lot of the trend started 5, 6, 7 years ago. And I think that is part of the reason when we look at like refined product demand in China from crude, it's definitely has decelerated. And their electric vehicles, I mean, the fact that they make such inexpensive electric vehicles and are pretty reasonable and you travel a lot. So I'm sure you see Chinese vehicles in places that you had never seen them before.
And they're great quality, by the way. BYD is, I mean, I would choose it over a Tesla. It's really good.
Yeah, my cousins in Panama were just like, hey, this is better than Alexa's for half the price. And I was pretty amazed. And I do think they going to have an increasing ability to export low cost electric vehicles, which creates intellectual disconnect in the US. And because, we want to have an electric vehicle leadership and market. And that's where the barriers of trade are coming up. But I think in China, you're still going to see the petchem growth. There's still going to be a massive engine. But for refined source crude oil products, I mean, I think the growth rates have come down. The economic activity is really bifurcated, where you do see growth in some of like the electric vehicle manufacturing, alternative energy, investment in the grids to support that, from residential and I think a lot of consumer related industries, more service. And I think ironically, probably one of the reasons gold is so well bid in China. The ARBs onshore finally have gone negative, but they were still positive all the way through the rally to 2,400, which is, all-time high prices. I think it's because that is like what people are investing in now. And, instead of buying and building a home and using it as an asset, they're looking at something like gold. And that's not an way in which the real estate market. But I think there's some real challenges in balancing that.
Yeah, no, I completely got the same sense when I was just there, a couple of months ago, and I've never seen sentiment that bad. Like, it was almost like because their property or their investments have lost so much value, exactly to your point, they were just literally looking for assets, where gold is a classic example, where they felt they was safe, just didn't want to have exposure to anything which, after COVID and the property sector kind of, they would call demise in their words, it's been really challenging. And I think that's kind of my worry for the long term anyways, right, when it comes to economic growth. And I think the world economy has been so reliant on China and China growing and oil markets, for sure.
But I think the
And,
balance of that is the friend shoring, near shoring, China plus strategies, or whatever the right nomenclature is, means that the outlook for Southeast Asian demand actually still is pretty darn robust. It just
yes.
isn't sourced China only, but almost that rebalancing is inherently good. I mean, I feel like we've had a gross imbalance for so long in global
Yeah, yeah,
trade and
100%.
manufacturing. So I think there's just, when you look at Indonesia and you look at other countries, I think they're real beneficiaries of that. Um, so yeah, it's always challenging because one could, in any time, have one narrative that dominates the global. And sometimes that is really the most important thing. If you say COVID was just a narrative, that was a very problematic conclusion, right? So there are times when something is ever, but a lot of times, China decelerating while by itself is not supportive for commodities like it was if they were still growing when post the WTO integration. But we're getting real genuine growth and much better fiscal management in other parts of the emerging markets, and they're getting the benefits of it.
No, that's a very fair point. Look, I'm conscious of time, and you've been very generous with your time. But I do want to ask you a couple of kind of last questions. Pick your brain on. I mean, what is it? I mean, we've talked quite a bit about like what you think is mispriced. What about like other asset classes? Because obviously you have exposure to all sorts of clients, right, in terms of your investors. What else is on their radar that often, the oil market doesn't even look at, right? Because often I find the oil market's wearing blinkers.
Well, I mean, in our view, there's definitely the prospects for positive returns and diversification in fixed income now is meaningfully better. If you look at real yields as an indication, a little bit recently, but at one point we were at the highest level since pre-GFC. When you're looking at real yields in the 220-ish area, historically that's mapped to like a forward 6 to 7% positive return historically. So I think there is meaningful rebalancing of portfolios from a very high concentration in equities for a very long time to a more balanced portfolio. Like the 60-40s were probably tilted too far away from that, and now almost we would argue 50-50 or 40-60 is something that investors should be contemplating. Now there's also a lot of interest in investors to smooth volatility of the returns. Now sometimes, a lot of times, that's just an optical decision.
Yeah.
You don't actually, a lot of private real estate is not marked to actual tradable values. They're just marked to some sort of modeled portfolio value. But there's definitely a lot of clients who find that appealing, having a lower vol. So that's one of the challenges when you think about clients who want to own commodities, is that it is one of the higher volatility asset classes.
Of course.
And when there's definitely an effort to like think about portfolio vol diversification, real assets outside of owning something like commodities can be quite appealing to a number. Now, to be clear, those didn't offer a lick of diversification. In 2022 and 2023, commodities were one of the best performing asset, or 21 and 22 were one of the best performing asset classes where everything else was bad. And the duration
Yeah.
of your illiquid real asset portfolio was massive and you had no ability to exit. And commodity investors who are long had the opportunity to rebalance and be offensive, or they're getting capital calls on existing commitments. And, we were the liquid diversifying. So in many respects, we just had a case study of exactly why you have to own commodities. But at least in the US, that's still that reticence and preference for, a private real asset. But real assets are really climbing up the scale of what the interest is also, given the volatility that just happened. It just might be real estate or infrastructure that they find appealing, but they don't provide the liquidity.
That's fascinating, genuinely, because yeah, I think just the way you framed it exactly is right, and I've heard that from a few, of the macro guys we speak with as well, that the kind of exposure or the desire to have exposure to kind of real assets, as you said. Is there anything that, I mean, other than, like you said, you want to move to London for the next 4 months, and you and your family are always welcome here, trust me, so anytime. But anything else that you are worried about in terms of, could be portfolio, could be just kind of markets, like what should we be thinking about that we maybe haven't been thinking?
Well, I mean, one of the topics of discussion that we've had a lot about is whether or not the fiscal balance in the U.S. is going to improve under any new administration. And in fact, we think it's, and as a result, we look at the long dated, markets and think that there's a real chance that whether it be a steepener or there could be a repricing higher in that because there's going to be a growing fiscal deficit that is not being addressed in any serious way. So we do spend a lot of time talking about those imbalances and what's the outcome or what's the solution to dealing with that. That's a big topic of conversation that we have, and that's a level of uncertainty. Like if you get into a world where that real credit is being challenged, I mean that will, in our mind, be negative for risk assets.
Oh
So
yeah,
that's
for
one
sure.
thing.
And global growth. Yeah.
Yeah, that's one thing to put out there that we're concerned about. But in terms of commodity markets itself, I mean, there's just a lot of opportunity, even though the headline volatility numbers may not be great. We've seen a lot of volatility in intra products or, whether it be time spreads, there's still a considerable amount. And I do think we've seen meaningful growth in non-traditional players doing alpha baskets, packages of different sort of diversification like strategies. That also means we probably have a good amount of crowding into many of them. And I think that creates some extra amount of volatility in the front end of the curve that may not be consistent with what other price action is doing. So I think there's going to be a lot of opportunities in understanding those implications of the growth and those sort of what, lack of a better word, alpha baskets have brought into the market.
Fantastic. Well, thank you, Greg, for joining us. And that was genuinely super fascinating because, again, you've provided such a rounded view of, what investors are really looking for. And yeah, hopefully we can do more of this in the future. So thanks again for coming on.
Thank you for having me, and nice seeing you.